There is a specific, stomach-dropping sensation that happens when you log into your retirement account during a market crash. You watch decades of saving and compound interest suddenly fracture and collapse, and there is absolutely nothing you can do to stop it. Or is there? Some investors spend their entire lives trying to outsmart those crashes. But what if you could engineer an investment strategy that simply ignores market panics entirely? This chart tracks two very different investment paths over a 10-year period. One path takes you on a wild ride, with steep drops and high peaks. The other path gives you a smooth, predictably boring, upward-sloping line. That smooth line is a heavily defensive portfolio. It shields your capital from plunging deep into the red during a crisis, but by design, it mathematically prevents you from ever reaching those extreme euphoric highs. You cannot have maximum upside growth and maximum downside protection at the same time. Eventually, every investor has to look at these two lines and decide which ride they are willing to take. Billionaire investor and Bridgewater Associates founder Ray Dalio made his choice decades ago. He created what is now famously known as the all-weather portfolio. Dalio operates on a very specific philosophy. A truly resilient portfolio should not rely on endless bull markets. It must be explicitly constructed to survive wildly unpredictable economic conditions. But here is the catch. The exact same financial mechanisms that protect your money from evaporating during the crash will act like a heavy anchor dragging you down when the economy is booming. To figure out if you should actually use this strategy, we need to decode exactly how this portfolio behaves across different economic climates and map out whether your current stage in life requires you to wear this heavy armor. The all-weather portfolio functions as a highly specialized defensive shock absorber for your wealth. This matrix breaks down Dalio's foundational concept, the economy's four seasons: growth, recession, inflation, and deflation. Traditional stock-heavy portfolios rely almost entirely on the growth season. If the economy shifts into the other seasons, they are left completely exposed. The solution to this vulnerability is allocating capital into non-correlated assets. Simply put, you purposefully buy things that naturally move in opposite directions under the exact same economic pressure. For example, when a recession hits and stock prices plummet, bonds often gain value. By holding bonds, you build a vital defensive wall that offsets the bleeding from your stock losses. But pulling your money out of stocks to buy those defensive assets introduces an unavoidable trade-off. You are intentionally capping your upside potential during sustained economic expansions. Mixing these non-correlated assets guarantees you will not get wiped out when the market crashes. It also absolutely guarantees you will underperform the stock market when times are good. Then there is inflation. It acts as an invisible, destructive force, silently eroding the purchasing power of your cash over time. To survive high inflation seasons, this portfolio requires you to permanently allocate a portion of your money to gold and physical commodities. Gold often moves independently from corporate share prices. When the cost of living spikes and panic sets in, hard commodities provide a structural, physical hedge against a devaluing currency. Yet, completely unlike shares in a thriving business or a treasury bond, a bar of gold does not produce quarterly corporate earnings. Holding these non-producing assets creates massive drag on your total returns during periods of low inflation and high growth. While tech stocks are compounding, your gold is just sitting there in a vault. Achieving total immunity to inflation means you have to carry that dead weight through the years of prosperity. If you actually want to build this portfolio, the practical reality usually involves buying low-cost exchange-traded funds, or ETFs, to get broad exposure to these different markets. You might buy shares in the iShares Gold Trust for your inflation hedge and pair it with the Vanguard Total Bond Market ETF to secure your taxable, investment-grade U.S. bonds. Over time, winning assets grow and warp your portfolio's proportions. To fix this, you must complete a mandatory maintenance requirement, rebalancing. This painfully forces you to actively sell winning assets to buy losing ones, restoring the target mathematical ratios. But this mandatory maintenance comes with hidden costs. If you are selling those winning assets in a standard taxable brokerage account, you can trigger a wave of unwanted capital gains taxes. Beyond the portfolio itself, financial advisors recommend adding one final defensive layer for retirees: holding 1 to 2 years of living expenses in pure cash, so you never have to panic and sell off your valuable assets during a sudden, terrifying market downturn. But keeping that much heavy cash in reserve guarantees you will lose money to inflation year after year. Successfully running the all-weather strategy requires active discipline, careful tax planning, and a willingness to accept constant cash drag. With all of these heavy trade-offs on the table, who actually needs to use this portfolio? This flowchart filters the decision down to a single determining factor, your exact time horizon to retirement. Let's follow the first path. If you are already retired, or fewer than 5 years away from leaving the workforce, this strategy is an incredibly strong match. At this stage, you no longer have the timeline to recover from a sudden 30% market crash. Capital preservation becomes far more valuable to your daily life than capturing peak market growth. Now, follow the second path. If you are a young optimizer with 15 to 30 years left until you need the money, applying this strategy creates a massive opportunity cost. For young investors, market volatility is not the enemy. It is the required price of compounding returns. Paying for a defensive umbrella when you don't need one will severely stunt your wealth. The all-weather portfolio represents a purely defensive posture, a tool for capital preservation prioritized over aggressive wealth generation. The best portfolio for you isn't the one with the highest theoretical returns on paper. It is the one you can mentally stick with during a panic without selling at the bottom. Audit your current life stage and your actual risk tolerance. Make sure you are not trading away necessary long-term growth just to feel a little more comfortable today. Align your financial strategy with your actual timeline and ignore the hype of billionaire buzzwords if their solutions don't fit your reality. In investing, psychological peace of mind has a specific, measurable price. Make sure you are in the right season of your life before you choose to pay it.